In any business, including healthcare, financial management involves planning, obtaining, and using capital to maximize the worth and efficiency of a company. This is an overview of healthcare finance. Healthcare finance differs from many other businesses in several ways. Many healthcare organizations are not-for-profit organizations, which in itself brings different rules and regulations than a for-profit business. We will discuss these differences later. Healthcare organizations also differ in the fact that they deal with third-party payers and negotiate contracts and prices. Working with third-party payers brings many complexities to accounting, billing, and collection processes of healthcare organizations. Billing can be a very intricate process that relies not only on the type of contract with the third-party payer, but also on physicians who may or may not be direct employees of the organization. Payment from third-party payers often relies on thorough documentation from these providers who are more focused on patient care and less focused on documentation and billing. Healthcare also has allowances for charity and courtesy care. Healthcare finance can also include decisions about mergers and joint ventures along with integrated delivery systems. Many of the components of healthcare finance are not easily predicted, which also adds to its intricacy. As we've already indicated, billing and coding in healthcare is very complex and involves many important steps. The accuracy of these steps are vital to the continued existence of a healthcare facility. The first essential step in billing occurs before the care is delivered. This step involves gathering information needed for the billing process. During registration, a patient's insurance information is gathered or verified to ensure the correct information is on file. This helps to ensure that timely billing occurs to the third-party payer. Also during registration, any copays or deductibles are calculated and a patient is informed of their financial responsibility. The patient is then encouraged to consider paying all or part of their expenses during the registration process. During registration, any needed financial counseling is done, and payment options and other financial assistance the patient may be eligible for is pursued. Once the patient enters the healthcare system and services are provided, this information needs to be recorded in a medical record and translated into coding to be able to bill the payer. The Health Insurance Portability and Accountability Act designate two specific coding structures that are used in reporting to payers. The International Classification of Disease 10th Revision, known as the ICD-10, is one, and the Healthcare Common Procedure Coding System, known as HCPCS, is the other. Capturing the charges for services performed can sometimes be difficult. It relies on the provider of the service to document details of the services provided. This can be done on paper or electronically. If this information is not accurate, it can lead to incorrect billing. All supplies and services performed are represented by a specific charge code that links that item or service to a department, a price, a revenue code, and a CPT or HCPCS code. Claims are then submitted usually electronically to a payer or a clearinghouse. Claims are reviewed or edited before submission to detect errors. This is done to ensure maximum payment, but also to ensure the payer will not reject the claim, which will delay the payment. Once claims are submitted to the payer, they are also reviewed by the payer. Payers are looking for errors because they do not want to pay more than owed, and they would also like to delay payments as much as possible to keep the money in their books longer. Payers and healthcare providers will both review records to ensure the documentation matches the charges being billed. After a claim is reviewed by the payer, if a discrepancy is found, several things could happen. The full claim could be rejected and sent back to be corrected and resubmitted. The full claim could be denied without the option of appealing or resubmitting. The claim could also be returned to the provider for corrections, and the full claim can be resubmitted. The claim could also be suspended, and further information is requested by the payer before they will process the claim. Individual parts of a full claim can also be rejected, with the ability to resubmit, or that single item is denied without the option of resubmitting, and the rest of the claim is paid. Calculating cost per patient is extremely important in healthcare, especially when dealing with competitive discounting. Costs must be calculated and allocated to a patient encounter. Direct costs are fairly easy to allocate, while indirect costs, such as housekeeping or other services from other departments, are more difficult to allocate. Costs for patient encounters are broken down into service units, which define the different services provided. These service units have specific costs assigned to them. A service can be a single lab test or can be a bundled procedure including all items normally used in that procedure. A standard costing profile defines the service unit that is being costed and outlines the resources required to produce the service unit. It must outline the direct expenses plus any allocated overhead. Standard treatment protocols are comparable to job order costing used in other industries. A separate cost sheet is prepared for each service, which then serves as the bill. In healthcare, payers rarely pay the actual cost of a service provided, but rather pay a fixed predetermined price for a specific procedure or diagnosis. Relative value unit (RVU) costing is used in many healthcare facilities. This cost assigns relative weights to regularly produce current procedural terminology codes. Costing is not only used to bill payers, but is also important information for planning and decision-making in an organization. Here are some examples of financial statements taken from the Essentials of Healthcare Finance textbook. First, we will look at a balance sheet. A balance sheet is a snapshot that shows an organization's assets, liabilities, and net assets or equity at that specific point in time. A balance sheet should always balance, meaning if you add the organization's liabilities and net assets, they will equal the equity. Most balance sheets are shown in thousands of dollars like this one. In this example, on December 31st, 2014, if you add the liabilities of $620,427 to the net assets of $684,619, you will get the total assets of $1,305,046. The balance sheet is helpful in analyzing the type of assets and liabilities of that organization. For example, it can tell how much of the organization is owned by debt versus equity. The balance sheet also shows how much cash is available for short-term use, as well as assets that are not easily accessible in the short term. The same is true for liabilities. The balance sheet depicts the amount of long and short-term debt. Accounts receivable is also depicted on the balance sheet. In healthcare organizations, accounts receivable is typically different than other organizations because what is billed is often an amount that is less than the actual charges. This difference is called an allowance, which includes contracted allowances, charity, and courtesy care, as well as doubtful accounts, which are accounts that are not recovered due to the bill not being paid. Next, we have the combined statement of operations. This statement is also called the income statement. It shows us the organization's revenues and expenses during a period of time. Usually this is a year. The statement of operations represents operations in a given period better than a balance sheet does. It shows how financial position has changed through the organization's operations. It will show if profits were made in that given period. Creditors use this statement to determine if they feel the organization is a good risk to loan money to. Patient revenue is reflected as net patient revenue, which is the revenue less allowances. Gross patient revenue is the list price for services provided. The next statement is the combined statement of changes in net assets. This statement explains the changes in net assets during the year. Donations would be included in this statement instead of the statement of operations due to accounting standard rules and the restrictions placed on most donations. The last financial statement we will look at is a combined statement of cash flows. The statement of cash flows provides added data on the flow of funds within an entity and shows how the cash flow changed over the year. It also summarizes the sources of that funding and the uses for these funds. Generally, there are three sources of cash flow in an organization. They are operating activities, investing activities, and financing activities. This statement is also where provisions for bad debt are added back, as these are write-offs of a receivable. Every organization is subjected to regulations and legal obligations. Corporate compliance, as well as a written compliance plan, is a crucial part of reducing liability risk within healthcare organizations. The Healthcare Reform Act has changed many of the regulations impacting healthcare. The Act is designed to change healthcare from a fee-for-service payment system to a model that rewards providers for quality outcomes in caring for patients. Healthcare facilities are subject to penalties under the law. Fraud is an intentional act of deception and punishable under the law. The Healthcare Fraud and Abuse Program, directed by the Secretary of the Department of Health and Human Services and the United States Attorney General, coordinate, oversee, and enforce laws to minimize healthcare fraud and abuse. The Medicare and Medicaid Anti-Fraud and Abuse Amendments deliver criminal penalties for false claims for payment or for concealing an event impacting the right to receive a payment. There are also penalties for improper use of benefits. Medicare fraud can lead to many different criminal offenses. The False Claims Act is a federal government civil remedy for knowingly making false claims. Under this act, healthcare providers can be fined $5,500 up to $11,000 per claim for knowingly making false claims. Claims under the False Claim Act can be brought against an entity not only by a government organization, but can also be by an individual, sometimes known as a whistleblower. Anti-kickback statute and Stark laws are additional regulations that healthcare providers are subjected to, which prohibit rewards or bonuses for providing patient care. The Health Insurance Portability and Accountability Act of 1996, known as HIPAA, was put into place to improve Medicare and Medicaid programs. It developed requirements and standards for electronic transmission of health information and to improve the effectiveness and efficiency of the healthcare system. HIPAA was further developed by the Health Information Technology for Economic and Clinic Health Act, or known as HITECH, which allows for investments in health information technology. The privacy standards of the Acts define what covered entities may or may not release in regards to protected health information. Violations for HIPAA HITECH can range from a fee as little as $100 up to $50,000. State and federal laws also impact healthcare. These laws can regulate all types of healthcare providers, including insurance companies. Each state has different regulations and licensing requirements. Nonprofit health organizations also have specific rules and regulations to be in compliance with their tax-exempt status, funding, and charity care. All nonprofit healthcare organizations are required by the IRS to file an annual disclosure called Form 990. This form is open for public inspection. Healthcare facilities are also subject to the red flag rule, which ensures that programs are in place to detect, identify, and have a plan in place for addressing identity theft situations. Healthcare as other business is subject to antitrust laws, most notably the Sherman Act, the Clayton Act, and the Federal Trade Commission Act. These antitrust laws promote a free market that is competitive and free of the effects of a monopoly. As many healthcare facilities lean towards mergers and joint ventures, these laws play a big role in what can and can't occur in these situations. The Emergency Medical Treatment and Active Labor Act sets out guidelines on providing emergency care to everyone, regardless of their insurance or ability to pay. This law requires the facility to minimally stabilize a patient prior to determining their ability to pay or transferring the patient to another facility. As you can see, healthcare finance is very complex and requires a lot of attention to detail. If all the components are not in place, billing can be delayed or denied. Education, along with accurate coding and billing processes, are keys to the financial health and success of any healthcare institution.